They tell this story like it was a close call that proved the system worked. But in 1907, the system didn't work. It jammed. It choked. It waited for someone to give an order. And there was no one whose job it was to do that. No central bank. No lender of last resort. No official switchboard for panic. Just private banks, private fortunes, and a public that could smell fear the way a crowd smells smoke. So ask the uncomfortable question. When the money stops moving and trust evaporates, who actually has the authority to save a country? And a second question follows right behind it. If the rescue depends on a handful of unelected decision makers improvising in a back room, is that stability or just luck with better manners? The United States in 1907 was rich, ambitious, and strangely fragile. It had factories, railroads, steel, oil, and a growing sense that it was destined to run the century. But its financial plumbing was built for a smaller world. Banks didn't just hold deposits. They were the nervous system of commerce. Yet they were bound by reserve rules and by a gold standard mindset that treated liquidity like a moral issue. Too much cash in the wrong hands looked like weakness. Too little cash in the right hands looked like strength. Right up until it looked like failure. In that world, money wasn't just bills. It was confidence. It was a belief that a promise would be honored tomorrow. And once that belief cracked, it didn't matter what your balance sheet said on paper. A panic isn't a single event. It's a chain reaction of rational people acting irrationally together. You don't need everyone to lose faith. You just need enough people to wonder, quietly, if they should get out first. The spark in 1907 wasn't a war or a crop failure. It was something more modern, a high-risk bet in a tightly connected network, a play that assumed the market could be pushed like a lever, and that the men holding the lever could control the timing. That assumption, control, was the real tinder. Because even before the panic, New York's financial world ran on informal power. There were institutions, but there were also reputations. There were regulations, but there were also relationships. There were balance sheets, but there were also phone calls. And everyone knew something else. The federal government, for all its growing influence, was not designed to act fast in a financial emergency. It could talk, it could posture, it could investigate after the fact, but it couldn't inject trust into the bloodstream in real time. So the market developed its own emergency reflex. Clearinghouses, syndicates, quiet agreements among big institutions to support one another until they decided not to. That last part is the thing people skip. These private safety nets were voluntary. They worked only as long as the people who mattered believed the rescue was in their interest. In 1907, that belief was tested. The pressure started as whispers about a few players who tried to corner a market and failed. In a fragile system, failure is contagious. It makes people ask which institutions are connected, which loans are exposed, which deposits might be trapped. Banks aren't just banks. They are webs of obligations. If one strand snaps, the vibration travels. Trust companies sat at the center of this particular web. They looked like banks, smelled like banks, and served many of the same customers. But they often held less cash on hand, and they lived in a space that felt modern and lightly supervised. They had grown fast by offering higher returns and a different kind of prestige. That growth was the point. It signaled innovation. It signaled ambition. It signaled that the old conservative model was outdated. In good times, that story sells. In bad times, it turns into a question. If they grew so fast, what exactly did they take on to do it? When depositors began pulling money, it wasn't only fear. It was logic. If you don't know what a trust company holds, you don't wait for clarity. You turn your deposit into cash while cash still exists. A run isn't a vote on a bank's morality. It's a race. Once a run begins, even a perfectly solvent institution can die. Assets that are fine over months become poison over hours. Loans can't be called in instantly. Securities can't be sold without crashing prices. And the act of selling becomes proof that you're desperate. That's the trap. The public thinks banks hold their money in a vault. Banks don't. They lend it. That's the business. The system works only if people don't all ask for their money at once. In October 1907, enough people asked at once. The The stock market dropped. Call money rate spiked. Brokers needed cash to meet margin calls. Banks pulled back. Trust companies tried to raise liquidity. Clearinghouses became gatekeepers. The streets outside certain institutions filled with people who wanted what was theirs. Right now, you can feel the system tightening in on itself. Each actor tries to protect their own institution, and in doing so, they stress the network. Hoarding becomes rational, and hoarding becomes the very thing that makes collapse possible. At the center of this crisis wasn't a single villain. It was a problem of coordination. In a panic, the smart move for an individual can be catastrophic for a group. So the question becomes, who can force coordination? Not who is the richest, not who is the smartest. Who can make others move together when everyone's instinct is to pull away? In 1907, the only people who could even attempt it were private. Here's where the story gets uncomfortable. The rescue was not a clean, transparent plan delivered by public servants. It was triage. It was judgment calls. It was a small number of men deciding quickly which institutions deserved oxygen and which ones to be allowed to suffocate. And those decisions were made with incomplete information. Picture a room where the country's financial fate is being discussed like a business negotiation. People are calculating exposures. People are arguing about whether a balance sheet is honest. People are considering what will happen if they refuse help and a rival collapses. Now add the moral hazard question, even if no one uses that phrase. If you rescue recklessness, you teach the market that recklessness is survivable. If you refuse rescue, you might teach the market that nobody is safe. There's no perfect answer. There's only an outcome and the people who live with it. One powerful financier became the unofficial hub of this panic. Not by law, but by gravity. When a system has no central authority, power flows to whoever can assemble cash, command attention, and impose a timetable. It wasn't just about money. It was about credibility. If this person said, "We will support this institution," others could be dragged into agreement. If this person said, "No," the refusal could become permission for everyone else to walk away. That's what "no one was in charge" actually means. It doesn't mean chaos. It means leadership by private consensus, formed under duress, and shaped by self-interest. The process looked like this. Teams of auditors and bankers would examine an institution's books fast. Not a full audit, a wartime inspection. They'd decide if the institution was salvageable, and if so, what it would cost to stabilize it. Then they'd try to raise a pool of funds. A syndicate, a coordinated injection. Sometimes it was direct loans. Sometimes it was buying securities to support prices. Sometimes it was pressuring other institutions to contribute because refusing would be dangerous. And in the background, there was always a question of optics, not public relations in the modern sense, but the psychology of crowds. If the public sees hesitation, it assumes the worst. If the public sees decisiveness, it pauses. In a panic, pause is victory. Time is the currency you're really buying. But the rescues were not universal. Some institutions were supported. Others were left to fail. Why? Because rescue wasn't a constitutional duty. It was a strategic choice. One trust company became the focal point, and its fate became a referendum on the network. When it came under pressure, the private leaders had to decide, is this institution fundamentally sound but a liquid, or is it a sinkhole? If it's sound, saving could stop the run. If it's rotten, saving it could waste precious resources and still fail. So they inspected, they debated, and then came the kind of decision a central bank is built to make, but a private syndicate makes in a different way. They withheld support. That refusal didn't just affect one institution. It sent a message. If this one won't be saved, which one will? Run spread. The system began to improvise new forms of money. Clearinghouse certificates, IOUs between banks, instruments designed to substitute for cash when cash was vanishing into mattresses and safe deposit boxes. This is the part that reveals the deeper truth. In an emergency, money becomes whatever credible institutions agree to treat as money. That's not theory. That's a confession. Banks started using substitutes because the public currency supply was insufficient for a nationwide panic. It's not that the country lacked wealth. It lacked liquid, trusted tokens that could circulate without argument. So private institutions created them, quietly, pragmatically, almost as if they were doing what a central bank would do, but without calling it that. Meanwhile, the federal government hovered at the edge. There were discussions about moving treasury funds into banks, about supporting reserves, about doing what was legally possible. But the machinery of government did not move at the pace of fear, and fear does not wait for committee meetings. The pressure point became the stock exchange itself. If the exchange closed, markets could freeze in a different way. If it stayed open without liquidity, forced selling could collapse asset prices and destroy balance sheets across the system. So cash had to be found. This is where the idea of saving the country becomes less romantic. The rescue wasn't primarily about protecting small depositors out of compassion. It was about preventing a cascade that would destroy major institutions, major borrowers, and the broader economy. Deposit lines made the crisis visible, but the heart of the crisis was interbank trust. If banks stopped lending to each other, everything else stopped. The private rescue effort focused on the nodes that mattered most in the network. That's how you stabilize a system quickly. You don't save every leaf. You protect the trunk. And that logic has consequences. It means some people and some institutions are collateral damage. It means the public interest is filtered through the survival of the financial core. In the midst of this, another layer of power appeared: information control. When you don't have an official central bank statement, rumors become policy. A whispered insolvency can become a self-fulfilling verdict. So stabilizers had to manage not just money flows, but narrative flows. They needed the public to believe the panic had a ceiling. Sometimes that meant announcing support. Sometimes it meant refusing to announce anything at all. Sometimes it meant forcing institutions to present a united front, even if privately they were terrified. This is what crisis management looks like when it's improvised. It's messy. It's human. It's strategic. It's not inherently noble. It's closer to warfare than governance. Eventually, the immediate collapse was avoided. The panic eased. Cash returned. Markets stabilized enough to breathe again. And then the real fight began. Not in the streets, but in the interpretation. Who deserved credit? Who deserved blame? Was this evidence that private leadership could handle national emergencies? Or was it evidence that relying on private leadership was an unacceptable risk? Because the most important fact was not that the panic happened. Panics were common in that era. The important fact was that the rescue required a private individual to act like a central bank. That is not a reassuring design. It's a gap. It's an admission that the architecture of American finance had outgrown the government's ability to backstop it. If the rescue had failed, the country would not have said, well, that's capitalism. It would have demanded a new system. And in some ways, that demand began even with the rescue success. Success can be destabilizing too. It proves that intervention works. It teaches people to ask why intervention wasn't formalized, predictable, accountable. It also teaches another lesson, quieter and more cynical. If you are big enough, connected enough, and central enough to the network, someone will try to save you, not because you're virtuous, because your collapse threatens everyone else. This is the seed of a concept Americans would learn again and again in the next century, under different names. In the years after 1907, the political response gathered momentum. Reformers, bankers, lawmakers, and economists argued about what the country needed: a central bank, a new currency system, stronger supervision, a mechanism to provide emergency liquidity. But those debates were also power struggles. Whoever designed the new system would shape, who controlled credit, who influenced interest rates, who could expand or contract the money supply. In other words, who could steer the economy. The panic became evidence in the trial about authority, and the arguments weren't purely technical. They were about trust in concentrated power. Americans distrusted central authority, but they also distrusted private monopolies. They wanted stability without surrendering control. They wanted a system that could act decisively, but not tyrannically. That balance is hard in theory. In practice, crisis tends to decide for you. It's easy to say, Let the market discipline risk. It's harder to say that when payrolls are threatened, when commerce stalls, when ordinary people who never speculated in their lives lose access to their deposits because someone else made a bad bet. Panic makes abstractions personal. So the nation moved toward building an institution that could do, openly and officially, what private rescuers did behind closed doors. Not immediately, not cleanly, not without bargaining and compromise. But the direction was set. Here's the pivot that changes how you understand 1907. The story is often told as proof that one decisive private actor saved the day. That version makes for a neat hero narrative, even if it's dressed up as sober history. The deeper story is that the country outsourced sovereignty in its moment of vulnerability. When the panic hit, the United States discovered that its formal government wasn't the highest power in the financial system. The highest power was whoever could create confidence with money and coordination. That's a strange thing for a republic to learn about itself. And it raises a question that doesn't go away just because the immediate crisis ended. If the nation depends on private stabilizers in emergencies, then private stabilizers will quietly shape the rules that prevent emergencies. Not by conspiracy, by structure. Because once you are the one who stops collapse, you become the one everyone consults about how to avoid it next time. You become the reference point, the default authority, the person whose preferences are treated like common sense. That's how informal power hardens into formal influence. You can see it in what happened after. Reform did not simply reduce private financial power. In some ways, it reorganized it. It created new channels, new institutions, new committees, new levers, and it created a new kind of legitimacy. Decisions that had been made in private rooms could now be made inside an official framework, still influenced by powerful interests, but wrapped in public law. Whether that is progress or camouflage depends on where you stand. But 1907 forces you to confront the trade-off. A system without a central authority can be freer in theory. In a panic, it can also be more brutal because coordination becomes a privilege. And a system with a central authority can be stabilizing. It can also concentrate power so deeply that the public only notices it when things go wrong. If you want to understand the United States that followed, its financial architecture, its crises, its rescues, its recurring arguments about who deserves help and who doesn't, you start here, not with the dates, not with the headlines, with the moment people realize a country could be brought to the edge by a chain reaction of fear, and pull back only by a private network deciding it was time to act. And then you ask the question that lingers, because it has no final answer. When no one is officially in charge, someone still ends up making the call. So who should that be? And when the next panic comes, because history suggests it always does, will the people in charge be the ones we elected, the ones we regulated, or the ones with the ability to move money fast enough to change what the public believes is possible?